Good afternoon, class. Today we're going to go over Chapter 3, which is entitled The Accounting Information System. Chapter 3 is summarized with this slide. Basically, we're going to discuss the accounting information system, record and summarize basic transactions, adjusting entries, preparing financial statements, and financial statements for merchandisers. So the accounting information system, it collects and processes transaction data and disseminates the financial information to interested parties. It helps management answer such questions as how much and what kind of debt is outstanding, were sales higher this period than last period, what assets do we have, what were our cash flows or inflows, did we make a profit last period, are any of our product lines or divisions operating at a loss, and can we safely increase our dividends to stockholders, is our rate of return on net assets increasing. So basically it answers all types of financial questions that management may have. And so debits and credits. And so an account shows the effect of transactions on a given asset, liability, equity, revenue, or expense account. The double entry system, the accounting system, has a two-sided effect. And so recording done by debiting at least one account and crediting another. And so the debits and credits overall must equal. And so to further explain debits and credits, so you have an arrangement that shows the effect of transactions on an account. And the debit is on the left-hand side and the credit is on the right. This is an account can be illustrated in a T account form. So this is an illustration of a T account. So basically you'll have an account name, and then on the left-hand side, your debits will be recorded. On your right-hand side, your credits will be recorded. So this is just an illustration of a T account. And so if the sum of debit entries are greater than the sum of the credit entries, the account will have a debit balance. And so basically every account has either a debit or a credit balance. It doesn't mean positive or negative. It just means exactly that, a debit or a credit balance. And so the account has a name. Again, you have your debit side and your credit side. This is a T account. And here they have a couple of transactions. They have three of them. So transaction 1, they recorded the debit of $10,000. Transaction 2, a credit of $3,000. And transaction 3, a debit of $8,000. When you total the debits and credits, whatever side has the larger balance, that is what you call if it's a debit or a credit balance. And so here in this situation, you have $18,000 total for debit, and then you have $3,000 for the credit side, which will give you $15,000 a debit balance. And so if the sum of credit entries are greater than the sum of debit entries, the account will have a credit balance. So exactly the same situation. There happens to be more credits in this account, so it ends up having a credit balance. So the credits total $11,000 and $10,000 is your debit balance. And so you end up having a $1,000 credit balance overall. And so debits and credit summary. And so accounts, you have 5 typical categories: assets, expenses, liabilities, stockholders' equity, and revenue accounts. And these accounts have what are called a natural balance or a normal balance. And so your assets normally have a debit balance as well as your expenses. Your liabilities, stockholders' equity, and revenue accounts normally have a credit balance. That's their normal balance. And here in the illustration, they're showing you what happens when you debit or credit these individual accounts, whether they go up or down. The value of the account goes up and down. So that's basically what the illustration is showing you. But what's important here is that assets and expenses have a normal debit balance, and liabilities, stockholders' equity, and revenue have a normal credit balance. And so again, this is another illustration showing you the accounting equation. So you have assets equals liabilities plus equity, and typically equity ends up being the revenue and expenses close out to equity. And so here you have the accounts, what happens when they are debited and what happens when they are credited. And so assets increase when they're debited because they have a natural debit balance. Liabilities decrease, equity decreases revenue decreases, expense increases, because assets and expenses have a natural debit balance. On the credit side, liabilities, equity, and revenue have a natural credit balance, so they increase when you credit them. Assets and expenses are going to decrease when you credit them because they have a natural debit balance. So this is a good slide to use in your notes. The relationship among the assets, liabilities, and stockholders' equity accounts of a business. And so this is an expanded equation of debit and credit rules and effects. And so again, here you have the assets and liabilities plus assets equal liabilities plus stockholders' equity. And again, you have assets, liabilities, common stock, retained earnings, dividends, revenues, and expenses. And they're showing you whether if a debit or credit, what's the net effect if it increases or decreases for each one of these type of accounts. And so an example, double entry system illustration. So owner invests $40,000 in exchange for common stock. And so that entry's net effect is going to have an increase on your assets and an increase on your stockholders' equity. You're going to debit the assets and credit stockholders' equity. They disperse $600 cash for secretarial wages. Again, to decrease, this is payments, so you're going to decrease an asset like cash, and you're going to increase your expenses, which is going to have a negative effect on your stockholders' equity. Purchase office equipment priced at $5,200, giving a 10% promissory note in exchange. Increase asset, increase liability. Receive $4,000 cash for services performed. Increase an asset, and your stockholders' equity is going to increase because your revenue is credited, which is going to make stockholders' equity increase. Pay off a short-term liability of $7,000. You're going to decrease assets and decrease your liability. Declare a cash dividend of $5,000. You're going to increase your liability and decrease stockholders' equity. Convert a long-term liability of $80,000 into common stock. Decrease liability, increase stockholders' equity. So pay cash of $16,000 for a delivery van. That's a decrease in cash and an increase in your assets. So I want to note the ownership structure. So ownership structure dictates the types of accounts that are part or affect the equity section. And so for proprietorship or partnership, that's your owner's capital and your owner's drawing account. And for a corporation, that's common stock, paid in capital in excess of par, dividends, and retained earnings. And so recording and summarizing basic transactions. This is where you're going to take this double entry system idea of debits and credits and actually make journal entries and see how this all works out. And so you have the accounting cycles. First thing I want to note. And so this is it starts with transactions, and it flows to journalization, posting, trial balance, adjustments, the adjusted trial balance, statement preparation, closing out, post-closing trial balance, and reversing entries. And so we're going to go through this in depth. So transactions, identify and recording transactions. What to record. The FASB uses the phrase transactions or other events and circumstances that affect a business enterprise. And so types of events can be external between the entity and its environment, or internal event occurring entirely within an entity. And so basically these transactions at the top of this cycle, your daily activity at a business, buying, selling things, issuing stock, any type of economic activity normally falls into this transaction category. And then those transactions are journalized, which means they're recorded in some type of journal. Once they're recorded, they're ultimately posted to the general ledger, which means they're applied to individual accounts. Then once they're applied to the individual accounts, you can pull what's called a trial balance, and that's the listing of all your accounts that are in your business, and they normally should balance overall. They balance to zero, and it's the net visualization of the double entry system. From your trial balance, you typically have adjustments. Once you get to the closing of the cycle, you have some adjustments that you need to make. And then from there, you can create an adjusted trial balance that have these new adjustments that you made that are different than the daily transactions. These are accounting adjustments that you have to make at the end of the period. So you can create an adjusting trial balance, or you can go directly from the adjustments to preparing your statements. Once you're preparing the financial statements, these are the statements that our end users are using, and we've discussed prior. After the statements, you have some closing entries that you make to the system. From those closing entries, you can pull a post-closing trial balance, or if you do or not, and then you also reverse some of these entries. So at this part of the cycle, you'll have some additional entries, just like with the adjustments that you'll only make at the end of the year. And sometimes these adjustments need to be reversed before you go into the new year. So journalizing. And so general journal, a chronological record of transactions. And so journal entries are recorded in the journal. And so this is an example. September 1st, stockholders invested $15,000 cash in the corporation in exchange for shares of stock. And so they purchased computer equipment for $7,000 cash. And so what we have here is two transactions, and how you will journalize them. The first one is going to be a debit to cash and a credit to common stock. And the second one is a debit to equipment and a credit to cash. And so now you're transferring the amounts from the journal to the ledger. And so from that journal, you're going to transfer to the individual accounts. And so your entry here for $15,000 for cash is going to move to the cash account in the general ledger, and to your common stock account in the general ledger. That's the posting step after your journalizing. And so transferring amounts from the journal to the ledger. So next, an expanded example. The purpose of the transaction analysis to identify the type of account involved and determine whether a debit or credit is required. And so this is another example. October 1st, stockholders invest $100,000 cash in an advertising venture to be known as Pioneer Advertising Incorporated. And so here is an illustration of T accounts. And so in journalizing it, it's going to be a debit to cash and a credit to common stock. And this is how it would look in the T account. You're going to debit a T account for cash. You have the account name, debit and credit side, and you're going to debit for $100,000. And for common stock, the same thing. You're going to credit it for $100,000. Posting again, Pioneer Advertising purchases office equipment costing $500,000 by signing a 3-month, 12%, $50,000 note payable. And so again, you're going to debit equipment for $50,000, and you're going to credit notes payable for $50,000. And then this is how the T account will look. Equipment will be debited for $50,000, and notes payable credited for $50,000. October 2nd, Pioneer Advertises receives a $12,000 cash advance from R. Knox, a client, for advertising services that are expected to be completed by December 31st. On October 2nd, cash is debited for $12,000, and unearned service revenue is credited for $12,000 because the services are not completed yet. And so you're going to debit cash for $12,000, and you're going to credit unearned service revenue for $12,000. And here, cash has $100,000 in from a prior entry. So they're showing you how the accounts will bill transactions. October 3rd, Pioneer advertises $9,000 office rent in cash for October. And so here you have rent expense for $9,000 in cash is paid out for $9,000. And so you're going to credit cash for $9,000 and debit rent expense for $9,000. October 1st, Pioneer Advertising pays $6,000 for a 1-year insurance policy that will expire next year on September 30th. So you have a prepaid situation. So you're going to debit prepaid insurance for $6,000 and your credit cash for $6,000. And again, here are the T accounts. Now you have a new $6,000 entry to cash credit and a debit to prepaid insurance. And so October 5th, Pioneer advertises purchases for $25,000 on account an estimated 3-month supply of advertising materials from Arrow Supply. And so you're going to debit supplies for $25,000. You're going to credit accounts payable for $25,000. 2 new accounts, supplies and accounts payable. And so October 9th, Pioneer advertises signs a contract with a local newspaper for advertising inserts to be distributed starting on the last Sunday in November. Pioneer will start work on the content of the flyers in November. Payment for $7,000 is due following the delivery of Sunday papers containing the flyer. And so in this situation, there is nothing to do yet because the terms say upon delivery, and delivery has not happened. So no journal entry is necessary for October. October 20th, Pioneer Advertising Board of Directors declares and pays a $5,000 cash dividend to stockholders. That's a debit to dividends and a credit to cash in the T accounts below. Illustrated $5,000 credit, $5,000 debit to dividends. Employees are paid every 4 weeks. The total payroll is $2,000 per day. The pay period ended on Friday, October 26th, with salaries and wages of $40,000 being paid. And so you're going to debit salary and wages for $40,000 and credit cash for $40,000. October 31st, Pioneer Advertising receives $28,000 in cash and bills Copa Company $72,000 for advertising services of $100,000 performed in October. And so you're going to debit cash. They combine this entry, so you're going to debit cash for $28,000, and you're going to debit accounts receivable for $72,000, and then you're going to credit service revenue for $100,000. And these are the 3 accounts below: debit for $28,000, debit for $72,000, and a credit for $100,000. Now you could have split this up into 2 different transactions. They just combined it together. And you notice cash. You have a running totals in here with all these transactions we just discussed. And so now the trial balance, a list of each account and its balance, is used to provide equality of debit and credit balances. So this is an unadjusted trial balance, and you have your debits and your credits. And so this comes after the posting. Here are your asset accounts, your liability accounts, owner's equity, revenue, and expense accounts. And you notice that there's a total of $287,000 for debits and $287,000 for credits. Everything balances. So identifying, preparing, adjusting entries. So it makes it possible to report on the balance sheet the appropriate assets, liabilities, and owner's equity at the statement date. Report on the income statement the proper revenues and expenses for the period. And so revenues are recorded in the period in which services are performed, and expenses are recognized in the period in which they are incurred. And we talked about that with revenue recognition principle. And so these are types of adjusting entries. And so you have prepaid expenses, unearned revenues, accrued revenues, and accrued expenses. So prepaid expenses are expenses paid in cash before they are used or consumed. Unearned revenues is cash received before services are performed. Accrued revenues for services performed but not yet received in cash or recorded. And accrued expenses incurred but not yet paid in cash or recorded. And so these adjustments fall here after the trial balance, and they're only done in closing periods. You can do them in the monthly closes or year-end closes. but they're only done at certain times of the year. And so adjusting entries for deferrals. And so deferrals are either prepaid expenses or unearned revenues. And so here it shows you the entry for prepaid expenses, the credit adjusting entry to assets, and the debit adjusting entry to expense. And unearned revenues, you'll recognize a liability, a debit adjusting entry, and a credit to revenue. So an example of prepaid expense. So assets paid for and recorded before a company uses them. And so a cash payment before expenses are recorded. And so prepayments often occur in regard to insurance, supplies, advertising, rent, buildings, and equipment. And so here's an example of supplies for prepaid expenses. Pioneer Advertising purchased advertising supplies costing $25,000 in October. Prepared a journal entry to record the purchase of the supplies. And so debit to cash and a debit to supplies and a credit to cash because you purchased supplies. So an inventory count at the close of business on October 31st reveals that $10,000 of advertising supplies are still on hand. And so they're using October 31st, so they must be closing monthly. And so they're looking at the supplies. So in this situation, they're saying $10,000 is still on hand. And so as supplies are being used, they're expensing them. So this is why there's a $15,000 entry to supplies, a debit, and a credit to the asset supplies to reduce it. And so supplies has been reduced down now to $10,000. And so you have $10,000 on hand. So in your financial statements, once you move on past your adjusting entry, this is how it would look. The statement presentation, supplies identifies that portion of the assets cost that will provide future economic benefit. And that's the $10,000 should be recognized in the asset part of the balance sheet under supplies. In your statement presentation for income statement, supplies expense identifies that a portion of the assets cost that expired in October, which was the $15,000, identified here. And so this entry is based on this entry showing that you expense $15,000 and you still have $10,000 left. On October 4th, Pioneer Advertising paid $6,000 for a one-year fire insurance policy coverage beginning October 1st, prepared the entry to record the purchase of the insurance. And so you would debit prepaid insurance for $6,000 and credit cash for $6,000. This is recognizing the purchase. An analysis of the policy reveals that $500 of the insurance expires each month. Prepare the entry to record the insurance costs expired in October. So again, you're just looking at that month. And so you have $6,000 divided by 12 gives you the monthly amount. And so you would expense $500, just like in the supply situation, you expense $15,000 because that's what you used. You're only using $500 of this policy for this month. And so you're going to debit insurance expense and you're going to credit the prepaid insurance. And so the $500 from the insurance expense is going to find its way on the income statement. And the $5,500 that's left in prepaid insurance is going to show up on your balance sheet. And so here you have your balance sheet. Supplies is listed at $5,500. And so the prepaid insurance identifies that portion of the assets cost that will provide future economic benefit. And your income statement, the $500 that was expensed. Insurance expense identifies that portion of the assets cost that was expired in October. Now, they're going through each one of these as an example, but normally you would do all of these entries and then you would record everything on the financial statements at two separate times in their totality, not just like this one account all the way through. So depreciation, Pioneer Advertising estimates depreciation on its office equipment to be $400 per month. Prepare the entry to record depreciation for the month of October. And so appreciation is going to be debited uh, depreciation expense for 400, and you're going to credit accumulated depreciation. Accumulated depreciation is a contra asset account. It goes along with inventory. And so what you're trying to show is the amount that you've used for the depreciation expense, the amount that you're expensing. And for accumulated depreciation, you're trying to show the value of the asset, but you don't want to go in and make an entry directly to your property, plant, and equipment account. And so you use a contra account to offset. And that's what accumulated depreciation is. And so here you have the balance sheet. Accumulated depreciation is a contra asset account again. And so here it's listed at $400, and it goes directly against your equipment account. And so the net effect is $49,600 in equipment. But you're not adjusting your original equipment basis amount. And then on the income statement, depreciation expense identifies that portion of the asset's cost that expired in October. And again, you had $400 expire. And so just like salary expense, we use $15,000, insurance $500 so far, and now they're showing $400 in depreciation expense. And so unearned revenues. And so the receipt of cash before the services are performed is recorded as a liability called unearned revenues. So this is, again, a part of the adjusting interest at the end of the quarter, month, or year, whenever you're recognizing it. And you just want to clarify that you haven't earned these revenues yet, so you have to record them differently. And so unearned revenues often occur in regard to rent, airline tickets, tuition, magazine subscriptions, and customer deposits. And so, for example, tuition would be if someone prepaid for all 4 years, which happens at some colleges, you would recognize a portion of that as unearned until you actually provide the service. Same with airline tickets. A lot of their revenue is unearned until the person actually takes the flight. And so here, unearned revenue, Pioneer Advertising received $12,000 on October 2nd from KC for advertising services expected to be completed by December 31st. Prepare the journal entry to record the receipt on October 2nd. And so here, cash is debited for $12,000 and unearned service revenue is credited for $12,000 to recognize the amount they received. And they give you an illustration of the T accounts. Unearned revenue analysis. So analysis reveals that Pioneer Advertising earned $4,000 of the advertising services in October. Prepare the entry to record the revenue for services performed. And so here you're moving funds from the unearned service revenue account. That's why you're debiting it, and you're crediting a service revenue account to recognize the $4,000 that you actually earned. And so now the unearned service revenue T account is only showing $8,000 left, when your service revenue account has been increased by the $4,000. And so on your balance sheet, unearned service revenue identifies that portion of a liability for which services have not been performed. So that $8,000 is going to show up as a liability, which means because you have not earned it at any point in time, the person may change their mind up until the point that you deliver the service, and so you may have to pay it back. So that's why it's considered a liability. And on the income statement, service revenue includes the portion of unearned service revenue for which services were performed in October. And so here you have $106,000 in your service revenue. And so adjusting entries for accruals. So accruals are either accrued revenues or accrued expenses. And again, the adjusting entries for accrued revenue is a debit to an asset and a credit to a revenue. An accrued expense is a debit to an expense and a credit to a liability. And so revenues recorded for services performed but cash has yet to be received at the statement date are accrued revenues. And so adjusting entries results in revenue recorded before cash is received. And so accrued revenue often occurred in regard to rent, interest, and services performed. And so this typically happens if something happens at the end of the period where you haven't collected for a service you performed you're able to recognize the revenue. And this is the process that you take. And so in October, Pioneer Advertising performed services for $2,000 that were not billed clients before October 31st. Prepare the entry to revenues for services performed. And so here you have a debit to accounts receivable for $2,000, and you're recognizing service revenue for $2,000. And so in this situation, they're recognizing the services performed, the revenue they will collect, even though they have not collected the cash. And once they do collect the cash, they're going to offset it against that accounts receivable. They'll debit cash and credit accounts receivable to zero out the receivable. And so on the balance sheet, you see you have your accounts receivable account and your sales revenue are impacted. And so adjusting entries for accrued expenses. So expenses incurred but not yet paid in cash or recorded. And so adjusting entry results in expense recorded before cash is paid. Often expenses in this regard are rent, interest, taxes, and salaries. And so accrued expenses. So Pioneer Advertising signed a 3-month note payable in the amount of $50,000 on October 1st. The note requires interest at an annual rate of 12%. 3 factors determine the amount of the interest accumulated. And so these are the 3 factors here: the face value of the note, the annual interest rate, and the time in terms of 1 year gives you the interest. And in this situation, it's $500. And so Pioneer signed a 3-month 12% note payable in the amount of $50,000 October 1st, prepared the adjusting entry October 31st to record the accrual of the interest. And so here your debit interest expense for $500 and interest payable of $500 is credited, and the T accounts are below. And so this is the amount of the notes payable that you have to recognize for that period. And so again, it's recognized in your statements: interest payable for $500 and your interest expense for $500. Accrued expenses. And so accrued salaries and wages at October 31st. The salaries and wages for these days represent an accrued expense and a related liability to Pioneer. The employee receives total salaries of $10,000 for a 5-day work week or $2,000 per day. And so basically we're talking about the days that they're paid that go into the next month. And so employees receive total salaries and wages of $10,000 for a 5-day work week. Prepare the adjusting entry October 31st to record accruals for salaries. And so salaries, we're recognizing $6,000 for salary and wages expense, and salary and wage payable for $6,000. So you're going to debit salary and wages for $6,000 and credit salary wages payable for $6,000. On November 23rd, Pioneer will again pay total salary and wages of $40,000. Prepare the entry to record the payment of salary on November 23rd. And so salary and wages payable are debited for $6,000 and salary and wage expense are debited for $34,000. Cash is credited for $40,000. And so even though they're paying $40,000 in November, you're not recognizing the whole $40,000 expense because you recognize $6,000 in a previous period. So that's why you use the salary and wages payable to offset that entry. And so here's your $6,000 recognized in salary and wages payable, and your $46,000 in salary and wages expense. And so accrued expenses. So bad debt. Pioneer Advertising reasonably estimates a bad debt expense for the month of $1,600. Prepare the entry to record the bad debt for the month of October. And so bad debt is debited for $1,600, and allowance for doubtful account is credited for $1,600. And so in this situation, some of their receivables, they have to go in and mark down the receivables. So some of the receivables, they have to identify that they may not collect. And that's what this entry is recognizing. And so your allowance for doubtful account is a contra account that goes against your accounts receivable. Just how you had accumulated depreciation was a contra account for your inventory. And so here they're showing the T accounts. And so on your financial statements, the balance sheet, you have your accounts receivable, and then you have your contra account for $1,600, which gives you $72,400 in total. And so again, a contra account is an account that normally would have it can be an asset or a liability, and instead of having the natural balance, it has the opposite balance. So that way you can net it together with the account. And so it's an asset account, but instead of having a normal asset balance, it normally has a credit balance, and that's why it's called a contra account, because it goes contra to the norm. And so now your adjusted trial balance. And so it shows the balance of all accounts after adjusting entries at the end of the accounting period. So now we're going all the way through the cycle up to the adjusted trial balance. And so in the adjusted trial balance, you have those adjustments that we made, that we just went through for the accruals. And so now preparing financial statements from the adjusted trial balance. And so the financial statements are prepared directly from the adjusted trial balance of the income statement, retained earnings statement, and the balance sheet. And so here's an illustration identifying, just kind of giving you a guide on how these items are pulled from the adjusted trial balance and they flow over to the income statement and retained earnings statement. And the same with the balance sheet. Your assets and liabilities from the top part of your adjusted trial balance, how they flow over into the categories for your assets and liabilities on your balance sheet as of October 31st. So these are two very good slides for your notes. And so lastly, preparing closing entries. And so closing entries are to reduce the balance of the nominal accounts to zero in order to prepare the accounts for the next period's transactions. And so those are the accounts that are not your permanent accounts. Basically, you're talking about closing out your revenue and expense accounts. And so to transfer all income statement account balances to the retained earnings account in the owner's equity. And so balance sheet accounts are not closed because those are your permanent accounts, assets, liabilities, and equity. And so dividends are closed directly to the retained earnings account. And so here's an illustration of the closing entries. You have your retained earnings closing out. Your dividends closing out to your retained earnings, and your salary expenses and revenue closing out to retained earnings. And so post-closing trial balance. This is an illustration of what it looks like. And so the accounting cycle summarized. And so I try to go slowly and go over each one of these examples because they're very important. And so number one, you enter the transactions of the period in the appropriate journals. So we went over what transactions were and thus what those T accounts were to kind of help you visualize it, but you enter them in the journals. You post from the journals to the ledger. Then the ledger, it comprises the trial balance. So you take an unadjusted trial balance and then you prepare the adjusting journal entries to post to the ledger. And then after those adjusting entries, You take the trial balance after the adjustments and you prepare the financial statements. And then you have your closing entries following the financial statements, which are to close your retained earnings, close out to retained earnings, your income and revenue accounts. And then that gives you a final post-close trial balance, and then you prepare any reversing entries that you need to reverse. Typically, those where you recognize some accruals for revenue that you hadn't received yet and things of that nature. So that's the end of Chapter 3's lecture. Please go back and read Chapter 3 and review the other material in the module. Have a good day.